So thank you again. So this presentation today is on buying and selling items and tips, I'm sorry, that we've seen here, or I've experienced at Johnson Consulting that I want to share with those of you attending today. Our Johnson Consulting office is located here in Scottsdale, Arizona. And of the things that we do mergers and acquisitions, helping people sell and buy funeral businesses around the U.S. and in Canada. We help with business, we offer business appraisals, valuations, loan sourcings, that'd be refinancing or new acquisition loans, management, financial accounting, and bookkeeping, management consulting, so this would be strategic plans, incentive plan, compensation structures, performance review of the business health checks, ongoing monthly, quarterly accountability meetings, performance improvement consulting at funeral organizations, staff training, on-site webinars, and online. And then our JCG Performance Tracker software, where we conduct at-need and pre-need customer satisfaction surveying and sales analysis across the funeral space. As well as we have a life insurance training portal that we use with a third party, and a business and personal wealth advisors through JCG Capital for business personal wealth management, as well as case management software, FDMS case management software, Funeral Directors Management System, also a sister company of Johnson Consulting. So this is kind of the wheel of services of Johnson Consulting, and we're going to be focusing on the buy and selling today. So in particular, buy and selling experiences. And the quote that I used with this today was, "Your business is too valuable to leave anything to chance." So hopefully you'll glean some great tips today as you move ahead and acquiring and growing. There's nothing more exciting to do than that. Or if the time is right for selling either to internally or to an outside party, I'll give you some tips that we've run into at Johnson Consulting that can help you through this. So let's first talk about value. And I love this slide here because of the price versus value, and meaning that the value of your firm and the things that you've done within that firm drives that price. And those are some things I want to share. But also, what is the purpose? And because that will drive value. Of course, when we're trying to buy, we're trying to buy for as low as we can. When we're trying to sell, we're trying to get as much as we can. But what about if we're selling to an employee or family member? What about liquidating the business and selling the real estate separately? I see this at low volume firms with high real estate value. What about minority interest, marketability, and control? All of these things could have different outcomes and value associated with them. And so be aware of those. Going back up top, when I talk about selling to employee or family member, we like to use two columns when we're offering that guidance to our clients. And that being that one column is the buyer, meaning if it's the son or daughter, and there's going to be certain expenses that are going to reside within that business that wouldn't be if it was sold to a third party. We want to see what that column looks like and what that cash flow result is. And then I think in this case, for the father, the current owner or mother, that they get to see what that value looks like from a third party, and you kind of meld those together and try to meet in between. And so that's why you can have different values based on the different situations that are out there. So I want to keep you aware of that. So what drives value? What I want to talk about first is what we call the JCG value matrix. This is very important, and these are the things that are the non-financial aspects of a funeral business that while you're listening to this presentation or to gather these slides after this presentation, if you do strategic planning on an annual basis, these are items that ought to be up there to determine what can you do about them, is there something you should do about them, and what does the outcome look like a year from now, 5 years from now, 10 years from now, and do you like that outcome is, or is there something that you need to start working on? So property location, the path of progress in your town, what is that going to look like? These are the things that are going to drive value. Functionality of the facilities, is it bursting at the seams? Is it too large? Is it right for the next point, which is your case counts? And to that point, what does your case count trend look like today, in the past, in the future? What are your mix? What's the mix of your business look like today and in the future? How about your market share trend? These are all things as we look through these businesses that come to us. We want to understand these when we formulate a final opinion on value. And these are things that you will need to determine when you sell your own business, to determine just what value expectation you should receive, or when you're trying to determine the value for a business you're buying. Demographics trends, a full service business versus low cost. Those have different values associated with them. Personnel mix. What I mean by this is I looked at a business yesterday that the average age was in their 60s. And so nothing wrong with it. The business was operating great. But as a buyer, I have to be concerned, is everybody going to retire when I acquire that business, or will there be people there? And as a seller, what is that doing to my value as well? You know, are the good assets to my business? Your people is your most valuable asset. And what does that health look like now and in the future? You know, the life expectancy of the business in general. You know, looking in that crystal ball, how does it look for you in the future? Is the future bright? You know, when you're buying a business, you certainly would hope to see a long life expectancy. And so when you look at that from a buyer's perspective, you would hope, as a potential seller in the future, that you'd be able to offer that same vision to a buyer. And if not, then you need to determine what the next step is for you in your succession plan. Client specificity. I use this word. It is a word, specificity. And this relates to, are you serving all demographics, all faiths, or are you Jewish-only business, African-American only business? These businesses can have different values based on the buyer base that's out there to buy them. And so be aware of that as you're, again, thinking about selling and what that value may be, as well as how to drive more value in your business. So multiple locations. We always love keeping that total of how many locations we have, but some of the problem that can arise out of that is whether that's truly creating economies of scale, or if it's simply just scaled down economies. And so, you know, make sure each of those locations are adding positively to the value of the business, and review that, and whether or not that business needs to be there because it's preventing another competitor to be in that market. I think I have a slide a little later on for that, but these are things, again, that we look at for determining an overall value for a funeral business operation. Call volume size, of course, the larger the volume, certainly the more attractive it is from a ability to, when you make changes within an organization, to impact cash flow. The size of the market, and that's a kind of a scale comment. And when I say scale, meaning what is the potential for business in the future? Is it a combo operation? The funeral home, cemetery combos in large markets of good size, they drive incredible value, and something to consider that goes above and beyond what you hear in multiples out there of cash flow. And then covenants in place, and are they being assumed or expiring? And this would be if you were let's say you're acquiring a business, and there's a former owner there because the seller bought this business 8 years ago, and that covenant's about to wear out. And, you know, you have two owners you need to worry about? Or if you're selling, have you secured that for a buyer? Just, you know, keeping those type of things in mind, of securing that goodwill, which is a large value in a funeral operation. And then, are you the franchise name in the market? Certainly, if there's new competition, or if there is going to be new competition affecting value. And then in small markets where you have living quarters, you know, a place for finding a key person to come into town where they can have that opportunity to live at the funeral home if they desire, where it kind of becomes part of the compensation. I've seen living quarters be a nice value in smaller markets. So employment agreements in place for your staff, for the key staff. Are there options to buy in place that as you as a seller have to notify other buyers that come in that could affect their likelihood to furnish an offer if they feel like they're just helping somebody else buy that funeral home because there's an option there, or a first right of refusal? How's your OSHA compliance? How's your crematory? Are there capital improvements needed if you're the seller, are you leaving a bunch of capital improvements needed to be done that are critical, or would affect the likelihood of somebody making an offer, seeing that there's too much work? Or as a buyer, are you considering what needs to be done? How about environmental issues, ADA? Are there liabilities, lawsuits outstanding? I love that checklist I just went through, because it's a great kind of checklist for me to do once a year for my own funeral home. I do own a funeral home, and just see, kind of check myself and see if the future looks bright. And then I always use it again as I look and help our clients acquire businesses, or for myself when I look to acquire businesses. So the main point is, how does the life expectancy of the business look? And when a life expectancy looks good and the future is bright, well, obviously the value for your business, or the value for the business you're buying, will be higher. So we call that the JCG value matrix. So there's no doubt about it, when you're determining value and selling your own business or buying a business, we have to do a financial review. We have to create a budget, if you will, or what is called a pro forma, to figure out what that cash flow could look like with this business. And so the first step of this, because I'm going to offer you some benchmarks during this presentation, would be very helpful to you. The first thing is to make sure that you're forecasting the revenue correctly to this model that I'll offer to you. That way these benchmarks will make sense. So forecasting revenue, I love it if it's within your abilities and your finger strength to do a sales contract analysis. I love it because it helps you break out the mix. You can look at the calls per case type. You can identify the average sale per case type, the average sales per sales item within those case types. But in particular, what you're wanting to do, whether it's a contract analysis or a financial statement review, is you want to look at net revenues, meaning that cash advances are not included in these sales. You're looking at net revenues. It's important, I highlighted it in yellow because that's how these percentages will work off those net revenues that I'll give you as benchmarks for your own firm when you look to acquire, or as you're kind of modeling your own firm to figure out what it might be worth. So the purpose is to identify exactly how pricing strategies will impact sales as well. As you acquire another firm or sell, the acquirer looking to buy you, or vice versa, is kind of looking at what's the average sale look like, and if they're in your market, how does that compare to theirs, and are they going to be coming in and being able to influence average in a positive way, or are they a lower average? And it helps with your pricing strategies and consolidating businesses. So I love it. It's a very important part of this analysis. So the number two is the cost of goods. So cost of goods in our model would be caskets, vaults, urns, markers, rebates for purchases, any type of merchandise that is sold for the funeral. It does not include, in cost of goods, I can find tax accountants will include payroll and labor and things like that. We're not including that in here. So just these merchandise items that I've listed here. And the benchmark, I would say, in this category can be 13 to 19% of those net sales. It can be lower and very high cremation, direct cremation businesses that I use these benchmarks as a rule of thumb. Next is payroll. Payroll is the most expensive part of what you do. It's a service that you're providing, and it's an important part of what you do. So there's a lot of analysis that should go into this in determining your cash flow as a seller, or to determine the cash flow in a business you're interested in acquiring. And what would be included in payroll? Officers, full and part-time staff, benefits programs, contract labor, training, uniforms, anything associated with having an employee. And when I give you these benchmarks for this section of 25 to 35%, again, of net sales, we're talking about owner expense adjusted. So when you're creating this forecast, you're looking at, if you as the owner had to move to an island or just disappeared, what would need to be in your place, if anything? Sometimes there is no replacement needed. Sometimes you need a manager at whatever rate that is, but making sure that it's staffed appropriately without you there, and then you should be able to fall in these benchmark ranges that I'm providing. Next is facility. Building, this would be anything associated with a facility, building and insurance, telephone, utilities, repairs and maintenance, rental expense, just anything, again, anything associated with having a building. And a lot of us owners, including myself, I rent my building back to the business and I keep it separate. And without any rent, that benchmark in that section should be about 5 to 10%. The rent in our space, the funeral business space that I've seen, is typically 7 to 12% of net sales. So if the rent were included in this section, you would then add that on the 5 to 10. So with rent in that section, then your benchmark would be 12 to 22%. And they're triple net leases. So basically the tenant, meaning the funeral operation, is paying for everything. The owner of the building is just collecting rent checks. So there's the benchmarks for that section. Vehicles, insurance, maintenance, leasing, anything associated with having a vehicle, benchmark for this section, 2 to 5% of net sales. Advertising, donations, yellow pages, internet, everything associated with advertising, 2 to 6%. And then the section that kind of grabs everything else is this other G&A section. This typically has bank charges, bad debts, licenses and permits, office supplies, office expense, not associated with the facility maintenance, office expense, equipment leasing. This section typically 4 to 6%. I wanted to dive into the financial part of it because it's such an important piece of determining value, and the part that we all want to start with and figure out just what are we dealing with? Is this something what do we have as far as value to offer to a buyer? And as a buyer, what is the cash flow that I could buy? Because that's going to influence my decision on the purchase price. And the whole purpose of that is that at the end of the day, after you have the net sales and you layer in all those expenses and create this budget with its owner discretionary expenses adjusted, if you will, you then get to a cash flow number. Theoretically, you get to a net income number, but we're not going to have expenses in there such as depreciation and goodwill, amortization, non-cash expenses. We're removing all that because we want this EBITDA number that you hear about, this earnings before interest, tax, depreciation, and amortization. And why EBITDA? Because EBITDA is now showing you the cash available before debt payments. And this is important in determining value, your own value for your operation or the value in a business you want to buy. And it really leads for a buyer, what is the fixed charge coverage that my measure that I'm going to have to abide by? And for those of you that have dealt with banks, this is important to a bank. And that's basically, it's to say, for every dollar of debt, what do they want in EBITDA or cash flow? And I've heard banks out there be 1.35 or 135%. What that means is if you would follow this exercise I just provided and came up with an EBITDA, and let's say that your debt is going to be, your principal and interest is going to be $100,000 a year at a 1.35 fixed charge, the bank is then going to want to see that you have 135,000 in EBITDA, if you follow me. So that's just a high level explanation of that, and a very important exercise in determining value. The other thing I would say about the debt service coverage ratio is that don't be caught in a trap where the bank is satisfied with good debt service coverage ratio, but when you look at the bottom line, you only have $5,000 of extra cash a month. This happens with smaller firms, and it's something you need to be careful of in determining for yourself, regardless of whether the bank's comfortable on just how much excess cash flow you want on a monthly basis. So outside of the P&L review, lest we never forget that there are always capital expenditures if we want to keep on top of the building facilities and the operations. So they might not be on the P&L of the business you're looking at, but having a budget for new cars, new roof times or carpets, creating a savings plan is very important. Always keep that in mind. And if you're a seller and you're creating a long list of capital expenditures for the buyer, where it's very possible this stuff can come right off the value of the purchase price or value of your firm. So the bottom line and the common sense is keep your facilities in good shape, and the value will take care of you. So the conclusion, whether you're selling or buying, a clear understanding of the financial condition of the business is imperative. Bottom line, it's very important. I can't stress enough, and I'll have some additional slides on this as it relates to that. So let's talk about selling. And let's talk about for a moment whether it's a good time to sell. I'd just like to share that with you, just the experience that we're seeing this year and probably mid part of last year at Johnson Consulting, and that is that there is a lot of buyer interest in our industry, I hate saying industry, our profession, and that's a good thing. It's a good thing because we don't have to do anything, but it's nice to know we're loved. That people have an interest in what we do, that there is that value. It is our most valuable asset that we own, and not every profession has that ability to be able to sleep at night knowing that if they need out, there's somebody that would be interested in their business if they've been taking care of it. And so I would say if people have been thinking about selling, those that really have decided to explore the market this year. And it's been yielding great results for them. And I don't know, I equate that to the low interest rates still, and a lot of the investor interest outside of the regular buyers out there. Typically with any deal that we have that we're selling, I have to cut the buyer list off at about 7 to 10 buyers. There are plenty more, but just in the interest of confidentiality, just don't really go much beyond that. And so that's to say that there is a lot of interest, and hopefully that continues, certainly is very much right now. So getting your house in order, when you're selling, financial preparedness is huge. You want to have a clean, understandable financial statement, P&L and balance sheet, easily available with detail and support. There's nothing more concerning than if I'm interested in buying a place, or if I'm interested in selling, that I can't readily furnish clear and understandable financial statements. That flag will get raised quickly on a buyer's side, because that's what they have to use to determine that cash flow. So make sure that's in good working order. Prepare your P&L, good income and expense trends, prove clearly the cash flow available, have good receivables control, a good expense management. The personal expenses it's easy to identify and prove them out for drawing those out of the financial review as a seller or buyer, that there's good detail. And the bottom line is that you just got good record keeping. Make it happen. It can really impact value of a business that is doing well but can't prove it. So it makes some moves before selling. It's just so good to get a valuation done to really understand where you stand, so that you can make that a very good decision on your own well ahead of time as to whether now's the time, or if it's not because you didn't like the value, that maybe if we want to get from here to here, how are we going to get there, and what is that gap we need to do, and that evaluation is going to be a good starting point for you. So, and to me, to those that have multiple locations, I just see this. I don't see it a lot, but I see it enough that I should bring this up, that there are locations within a 2 or 3 location business that one business could be producing, having 90 calls a year, let's say, and but have a real estate value of $1.5 million. But the other ones have appropriate real estate value and a lot more call volume. And so what's happening is, when it's time to sell, you have real estate that's exceeding the business value at one of your locations. And so now the question is, how do you identify, how do you set up the value for your firm, the presentation to buyers, or as a buyer, how do you go in and buy that and still compete with the real estate value, which is heavy at one of the locations? And with that much value in the real estate, is it good that it's a funeral operation to begin with? Possibly, if it's keeping competitors out, but sometimes we don't look at it because we don't, our job every day is to take care of those families, but it's something important to make sure we're staying on top of. So, and I always use the 80-20 rule. It's called the Pareto principle, but certainly, be aware of whether you've got something that's bringing in 20% of your profits, but taking 80% of your time. What's your core focus? That's a big key here. And how does pre-need affect value? I always put this slide on its own because I get this question a lot. The fulfillment average versus the at-need average, we know that there can be shortfalls and discounts, and how does that impact value? The fact of the matter is, typically in a funeral home, I may be off here, but about 25 to 35% of the at-need business is pre-need turning at-need. And that revenue that's coming onto the P&L is coming onto the P&L at a discount, and then the result as you get down to the bottom of cash flow is a product of that. And so it is impacting the value both positively and with the discounts. It's kind of one of those things that is what it is, but the value associated with the pre-need is as it comes onto the P&L and flows to the bottom line to your EBITDA. I've had people that have a tremendous amount of pre-need in their books, and they're feeling like there should be some type of percentage of that volume that's on the books that's associated with value. The fact is, until it hits your P&L, depending on the state or maybe all states at this point, they could walk away, they could transfer. I mean, it's unlikely, but that's not how you would determine value for a funeral business. It would just be on those that turn at need. The good news about it is the larger the volume of pre-need business on a business that we look at, the more healthy we feel that business is in the future. And so, you know, an active pre-need program always helps drive value because it's a good marketing program. So how do we make our firm worth more? If you want to document these and put these on your strategic plan, I'd highly encourage you. But call volume trend, and do you have large call volume? Are you trending towards that or relative to your market? How does the business run well when you're not there? Does it run well without you? If it does not, that can impact value. I know a business that I've looked at recently that's going to be an issue, and that will impact the buyers, you know, especially those buyers that are looking at it as an investment. They would like to see the staff in place. So if you're removing those buyers, you have less buyers. If you have less buyers, you might have less value. So make sure that business is running well without you. You know, make sure the employees are not at risk of starting their own business. You know, are you taking care of the employees? Are you getting them involved in the right things and not handing them all the keys to all the contacts in your market? It's important. That's a fine line that you walk there. Are you the franchise name in the market? Do you compete well against good competition? I love that. You know, competing well and knowing that there's good competition in the market. You know, is there a good future for the market in general and the community? Do you have strong revenues with consistent average sale? Do you have good succession in place if you get hit by the bus or the next person gets hit by the bus? What are the protocols that you have in place for that or that you're working on? How about your property location? Is it in the path of progress, this functionality location? You can see a revisit here on these JCG value matrix components, the demographics, the personnel mix. You know, in general, again, if the life expectancy looks good, your value for your business should be good. And remember this as well, that you will get the most money for your business during a time when you don't need to sell. And that's the struggle that we all have. Just when do we pull the trigger? You know, things are good. The funeral business is a very rewarding business for those that had a business for many years. And it can be hard to decide when to go ahead and transfer all that annual wealth that comes into you for how well you serve the community to somebody else, because it's now that you're retiring, you're now on a fixed income, you know. And so just remember that you got to leave that opportunity for the next person to drive the maximum value, in my opinion. So just something to keep in thought. So the process, I want to review that, just a general 20,000 foot view, I'll say, process of selling. There's going to be first sitting down and determining what success looks like to you. What do you want out of this? I think it's a very important process before you even consider anything. You know, make sure you have basically an endpoint you'd like to get towards, and then as you move through the process, make sure you're getting towards that. And if you're not, you revisit whether now's the time. So next step being the financial review. Marketing package is what we prefer and what we do that drives a lot of value. That there's letter of confidentialities that go out. People are now reviewing the information. A structure is put in place by those buyers and a letter of intent is furnished to you. If that looks to be your value, then you move into the due diligence phase and more formal documents. These would be your purchase documents, and then hopefully to a closing. There are a lot of steps in between there. That's why you know, I say, this is the high level, but how much time does all this take? I've seen transactions close rather quickly, and I'd say 4 months, but I would say you're talking about a 6-month process, probably from beginning to end. I've seen them take much longer. It just depends, and the process should be, follow your speed and timeline. But keep in mind that I would put 6 months on it for when you're thinking about these type of moves for yourself. So, a few common questions that I get. One is, I have a lot of personal expenses in my financials. How will that impact value? My opinion is that it's not going to. Not if you know how to properly, if you're properly documenting it, moving out of the P&L, and you're still within benchmarks like what I've shown. Those personnel expenses will have nothing to do with the value, in my opinion, but it needs to be documented and clearly understood, and not just made up, if you will, that you guess that it's this or that. Again, that goes back to the good financial preparedness. But personnel expenses, it's fine that they're in there. If they're all in there today and you're wanting to sell tomorrow, there's a way to get back to that EBITDA without those in there, and furnish that to the buyers, and them to be agreeable upon that, as long as they can follow the path. So, what is typically included in the value? We're talking about the building, the furniture, fixture, and equipment. We're talking about everything that's needed to run that business. And we're also talking about not including everything that's not needed to run that business. You have extra lots, extra property for future expansion. These are open to discussion, or just other items, personal vehicles, what have you. So, going through and understanding what are those critical things that a new buyer would need to manage that business are very important as well, that you're not just giving the buyer additional assets that they will liquidate immediately upon buying the place and then use that to pay down their purchase price. So, will the buyer buy stock or assets? Typically, what we're seeing is that they're buying assets. We have a few we're seeing stock, but not many. And so, just a comment to make, I saw that more back in my days in the mid to late 90s, where it was kind of the last way to compete with other buyers and saying, I'll go ahead and buy all the stock, which has all the liabilities and problems, and a better tax situation for you, the seller. But so, assets is what we're seeing. So, what about personal family fixtures, equipment? That stuff would just need to be replaced by something that's of suitable nature, like I think of like a family heirloom clock or grandfather clock. You'd replace that with something appropriate. But think about the things that you would not want to include in your sell, but make sure they're replaced. So, what about the extra property? We talked about that. Other question is, when should I tell my people and my staff? And I'm sorry to say that it's one of those things that you should hold off for as long as possible. It's just can be very disruptive. Once people know, they're worried about their job, that they're worried about their future, and it just doesn't serve any good until you get close to the end of the transaction. So that's one thing that I highly encourage you to hold off on, because deals can fall apart. It's just and I can tell you that the buyer will want to do it early on, but you just caution you on just when that time comes. So, how many buyers are out there for my business? I mentioned that there's a lot. It's good timing right now. The time is right. If you're thinking there's just shoot, like I say, 7 to 10 buyers that typically we have for a business, and we end up breaking the remaining buyers on top of that out as ones that we'll go to if we're not successful in the early stages. It just can be very cumbersome, and with the amount of buyers that are interested in businesses at the moment right now. So, so let's talk about buying. I keep talking about this. I like this picture. I don't know if it'll be a big fish eating a little one, or vice versa, but the few components to buying. So, buying a business is definitely about cash flow. You need to pay off new debt that currently isn't there in that business, and you need a very good understanding of what it is. So, figuring out that cash flow is doing that financial modeling, absentee owner status modeling, using those benchmarks that was discussed, and reviewing that value matrix checklist one again. And because when you review that and use a scale of 1 to 10 in your opinion on where you think those those things will be. And when you're done, that's going to help you fine tune just what range of value you're going to determine. Are you going to consider to overpay because all those answers were tens and it's a great firm, or were there some issues in there? And it's a great way to get yourself mentally prepared on just how much you want to pay for a business and that matrix checklist. So the buying process, a little different, similar process as you can imagine as selling, but it's going to start with early on discussions. You know, you having coffee with the person you're interested in acquiring down the road or merging with, and just starting those discussions because it doesn't typically happen overnight and it requires a couple meetings. And so start those discussions, and then when it gets to a point where you can then sit down and determine what success looks like to them. Okay, you're the buyer, so now what's success look like to them as the seller? You know, signing a letter of confidentiality to make them comfortable that, you know, you understand the confidential nature of the information they're providing. Then doing that financial review, formulating your structure, proposing a letter of intent, assuming that moves forward, then your due diligence, your more formal documents, and your closing. And how much time does it take? Very similar, you know. So the process, once you are getting yourself in the door, that 4 to 6 months, but the process in buying a place could take years. And so it's never too early to start on that now, especially for firms in your market that would just be ideal on merging together with sometime in the future. Buying tips, you know, validating with tax returns. This was, you know, a lot of these things are lessons I learned. This is a lesson in a business that I bought with my family, not a funeral business, but the tax returns were manipulated. I mean, you have to be real careful, make sure the tax returns are validated. You know, a comprehensive employee review is definitely in order as you go in there and understand how things are run and how you're going to run it. You know, is there enough staff? How the benefit programs compare to what yours are that you're probably going to bring into this business, and how does that look? And then some, you know, kind of global questions you have to ask yourself is, will this acquisition make new competition come into town? You know, sometimes if it's a good competitor and you're competing well with them, do we need to just keep it that way? But the problem is, what if they do sell and you don't buy it and somebody else comes in? And, you know, I don't have the exact answer for you because each market can be different. I'd like to say in general, it's great to be able to have the opportunity to buy your competition or the other funeral home in your market. But is it always going to be a market where there needs to be options? We have helped clients sell businesses that, in particular, one client that had the only 2 funeral homes in town, and they stayed under separate names, and it worked for them. You know, so those are things to keep in mind as you decide, is this something I want to do? And remember this, because we can just get in our own way. We often do, and that is, you know, that you would say to yourself, well, you know, this really seems risky and the business is a mess. And I would ask you, was it supposed to be perfect? You know, there's a reason somebody's selling, and sometimes you can be lucky that it's perfect. But then if it is, and that's where you got tens and all those matrix questions, well, then now you're going to have a lot of people that want to buy that business as well. So, you know, owner is selling, they're tired, they're ready to get out, interest level is lower than in the beginning. So and keep that in mind as a seller, you know. So if I'm going to go back to that slide, if you have presented a perfect situation as a seller now selling your business, and your interest level is high when you're selling, well, based on this perspective as a buyer, you now know as a seller how you can drive value. So the reality check, people should be interested in buying businesses because they see opportunity. If you're not providing opportunity, or if as a buyer you don't see opportunity, that affects value, right? So you bought it, just keep in mind there's lots of uncertainty at the beginning. Reassure the staff, be open to their processes. Don't change everything immediately, in my opinion. Be very strategic in determining your implementation process and sequence, and get rid of your ego. Remember that, well, I can just share with you experiences where I've seen owners that sold that weren't great owners, that you would think have had bad reputation, you know, that would just, if people knew what was behind the scenes, they'd never go there. But the fact is that it's kind of it's the community's owner. They know them, and you gotta work in this gray area possibly. You need to understand how to massage that until you get your culture melded into that organization. So words of wisdom, some of the best deals you do, though, are the ones you don't do. So, know your business first and be prepared. So one thing I wanted to add into this presentation is succession planning, because buying and selling and succession planning, those are all three of those things go together, and succession planning is a big word, key thing out there. So in succession planning, when you're interested in divesting and it's internally, or you're interested in buying, remember that, are you preparing the family key employees for this event? And remember that great funeral directors don't make great managers, don't make great arrangers, managers, and owners. So, not all can go to the next level, and that's okay. But, understand, that succession plan. Are you addressing issues of capabilities? Are you working yourself out of the job? Are you creating job redundancy? Do you have a strategic plan? These are great things to ensure a great sell or transfer or purchase. If you're the buyer or the son, that you want to make sure those things are occurring for you. Are you keeping all the secrets in the community to yourself? What type of commitment has the key person, family member made to staying with the organization, either through an employment agreement or CNC, financial consideration, their own skin or financial money in the game, if you will, into that. And don't be in denial. They say denial is not a river in Egypt, so don't be in denial. And the valuations for both of you to consider, and I talk about this in two columns. What is the expected value that the seller should, if that's the father, should expect to receive, and then what is the level of value that the key staff or son or daughter should expect to pay because of additional expenses they may have, and kind of melding those two thoughts together. Just remember to start now. It takes some time. Dad, mom are used to from my own personal experience, dad, mom are used to the cash flow and feel they're going to live forever. And son or daughter are trying to conquer the free world. And so you start now, and you think about these things that can help drive value in a positive way, and that can make sure, as you as the buyer, either internally as an external buyer, will ensure success of that business. So what I'd like to talk about as I wrap this up for you before we take questions is the risk and rewards of buying and selling, and the impacts on value. And I run these slides a lot, but they really drive home a point. And here's a question I get, or maybe you're a buyer or you're a seller and you're trying to determine value. And I get a call where somebody says they're a 500 call firm, and they say, what's my value? Well, all three of these firms on this slide are 500 call firms, but they're not all worth the same. And as you look at it, I'm going to highlight the one that I think is the one that's a 500 call firm in particular, because Business 3 could be a 475 call firm, or it could be a 550 call firm. So, knowing what those trends look like, and then, I like to talk about calls and their impacts on value as well. And so let's take a scenario where you have a firm with an average net sale of 4,500 and budgeted calls of 500. So we'll use that 500 call firm. So we got this 2.2 million in revenue, and 22% cost of goods will be our assumption. I'm going to use an EBITDA projection of 30%, and I'm going to use a multiple of 6 times. So I'm going to say that this business is worth $4 million. Let's say you're the buyer or you're the seller, and you're looking into the future, and you're not, let's say, in the future you can gain 10 more calls before you sell, or as a buyer, you think you can gain 10 more calls. Well, let's look at what that does to the value of that firm if you can do that. So here's where the opportunity lies in either increasing your value as a seller or as a buyer. 10 more calls at 4,500 with the profit and that multiple, you're adding 200,000 more of value. We don't look at our businesses this way, but it's real. Keep that in mind as you move forward. And then what no good presentation will go without scaring you a little, but let's talk about if you lose 10 calls. Let's talk about if you lose 20 calls. Let's talk about if you lose 30 calls in the future at that same average, or if you again, if you increase them, then it's the opposite. But these are things to think about when you're looking at a firm to acquire, or your own firm, and determining what the value may look like in the future. So let's talk about average sale. Let's say you can grow your average sale more as a seller or as a buyer when you come in. The impacts on value, well, there's no additional cost. All this falls to the bottom line. And if you use that same multiple, you're adding 300,000 more value at this firm. And if you don't think it's real, by all means, continue doing what you're doing, but it is. And it really is a fun way to look at your most valuable asset. Quite honestly, when you step aside out of the day-to-day and look at how you're driving value for yourself as a seller or as a buyer in the future, this is why we do what we do, and why it's exciting for all of us to be involved in the funeral service today. So you can also lose 300,000 in value as well if that average goes down, or what if your average drops 150, or let's say it's $200. So these are real things that can occur. We don't look at it this way. I can guarantee in all of our firms, as we've seen rising cremation, lowering profitability, this has happened at some level within our own organizations. So things to keep in mind as we consider that buy-sell arrow in the future. And for the purposes of this presentation, I also want to talk about how the arrangers impact value. And so this is a good study on training. And if we're a buyer and we want to come into an organization and drive value and training, or if we're a seller and we want to drive value and offer training, let's look at these two arrangers, one at 4,800 and one at 4,200 average sale. Let's say they're both handling the same number of calls. Look at the impacts on value that each is contributing to the funeral organization, and this is real. This is just a real thing that is happening at every funeral organization, and it really presses the need for training and attention and collaborating with the staff on how best to offer our goods and services to the families that come in. There are some arrangers that get it more than others, and the question I would pose to you is, in the exercise I just showed you, what's the chances that both of those arrangers are getting this compensated the same, or the one that was contributing 162,000 less in value, that he's even getting more because he's been around and he or she's just a little grumpy and doesn't want to go through all that training. So again, real things. I'm sure if you gave me enough funeral homes, I could show you examples exactly where this is happening. Conclusion on this stuff, it's real, and that is that you can make things happen, you can watch things happen, or just wonder what's happening. But think about this comment, and that is, what if a year from now you wish you started today? And let's say a year from now you decided, I might want to explore the value of my firm, or a year from now you're now the buyer of a firm. What were you doing that led up to that occasion? Or you want to be a buyer, but a year from now a firm sells and you never went over there to say hi, or got your name out there, or explored what financing would be, or got yourself prepared in your own organization so that you could expand. Don't let it be too late, because it happens, and it will happen to somebody on this call, because there's too many on this call to not to happen to. And so, think about the things you can do now so that you don't wish a year from now that you started today. And with that is the conclusion of my comments on buying and selling. There's plenty more to cover, but I hope that I've given you all a good detail of things to review and consider in your own firms. And I've provided a slide here and some contact information. Reach out to me if you have any other questions. I'm a funeral home owner myself. I've been in the funeral business my entire life. And I think everybody comes from Batesville, Indiana, which is where my family comes from. That's what ends up happening. You get a funeral service, but I find great pleasure in helping others, and those that have received that help from me know that. And I hope that I can help you as well. Even if you just stop by, see me at a convention, or give me a call. So, thank you very much, Steve.
Okay, we have some questions already, and if people have been holding them, please type them in. So let's get right to it. First question is, if I have multiple locations and one is underperforming, what can I do? Is there anything I can do, I guess, to get the most value if I'm thinking about selling?
Right. So the question that I would have first, going back to some of my slides, is that location there, as much as the real estate is exceeding that value, is that protecting your other locations? Because there is some implied value associated with that may jeopardize the other locations that you have. So you always want to ask that question. And then the next would be really making sure you've got a good feel for what that real estate value is. I suggest an actual appraisal or a broker opinion of value. I like those, where a person that's always, that's selling commercial real estate can tell you because that real estate value, if it's driving your decision, you better know that you've got the exact, very close value. And so the next thing is that, don't be, misled by the fact that it's never bad, they're not making any more of it. So owning real estate is a good thing. And if you've got an operation in a piece of property and it's paying the appropriate rent that that building should receive, which a funeral home could potentially be doing, then you have a good tenant, if you will, and a piece of property that's the tenant's paying down your mortgage. I think what happens, though, is when it's time to sell, whether or not it's appropriate to transfer that real estate to the buyer. And so in presentations we've done is we give the buyer the option, basically that, hey, this real estate really is exceeding the business value. So, we know that it should be included, but we have to have that real estate included and then create a nominal value of the turnkey aspect of the business that's within that operation. So there's not a clear answer, but certainly the way to figure out the value that you want to be obtaining out of a piece of real estate, one way to do this, one rule of thumb I use is where if a piece of real estate's worth $1 million, go ahead and determine that as the business value using the metrics I just used. So let's say the building's worth $1 million and that included the business. So if that's the value and we were using a 6-time multiple, let's say we took $1 million and we divided that by that multiple of 6, and we'd have an implied cash flow that business should be producing of $166,000. And if we're to say that that's 30% of your revenues, then that means that building of $1 million should be producing $550,000 in revenue. And if that $550,000 in revenue is based on an average sale of $5,000, then we know that building needs to be doing 110 calls if you want to now that's one way to look at it. And it's not the only way, but it's a nice rule of thumb. So.
Okay. We have a question. What are some reliable rules of thumb for evaluating a funeral home?
Yep, reliable rules of thumb. So using those matrix components that I mentioned are very important, but reliable rules of thumb, cash flow, you're going to be basing it off cash flow, and then explaining multiples can be a dangerous thing. But, if you've got a small to medium sized firm and you're kind of middle road or high end of the road on the matrix questions, you might see multiples right now in the range of 5.5 to 6 times, maybe. But as you go up in volume and market size, and you still have to have those positive answers on the matrix, then those multiples could creep higher. But there's always a threshold based on just what the other buyers would pay. And so those are just general rules of thumbs. You hear rules on per call, a number of dollars per call, or a multiple of revenue. The biggest thing is on cash flow, because that's exactly what you're buying, the cash flow.
Okay. What were the EBITDA benchmarks that we should strive for?
Good question. I don't think I had those. So the EBITDA benchmarks you'd strive for using that financial modeling rundown that I provided are usually going to be in the range of 25 to 35% of net sales. And if you've got a cemetery, ironically, that could be much higher if you got an active pre-need program and it's a very large cemetery, or it could be much lower. I would say if you're operating a funeral home without rent and there's no owner, and you've normalized the expenses for owner, you've removed all the owner discretionary expenses, and you're not at least at 15 to 20%, well, then there's a good chance you got too much expense, or there's something else going on at the firm. So I really like the 25 to 35% EBITDA range. 30 to 32% is right in my wheelhouse, and knowing that we're not stressing the firm too much in expense reductions, and or that we don't, that we've got a nice, healthy operating business with good budget for marketing and what have you. I like that number. It can be much higher, though. I would warn you that firms with very high average sale, a lot of volume operating out of one roof, will have much higher EBITDAs than what I've described.
Okay, we have a lot of questions. How hard is it to get financing if you are not a director but plan on being an active owner?
It's not hard if you start now. You know, the SBA has rules, and they've changed those recently. But the you know, the big thing is going out and you just start the process. You reach out to a firm like mine. There's other firms out there that we do, and you start your hand in some firms, and you know, if you fail, that's how you learn. You know, you start learning how we're going to get this financing. There are financing sources out there that enjoy the funeral space. We know those contacts, and they can help with just identifying for you how much money you'll need and what the terms may look like, and then rightfully so, then what size firm you should be looking at.
Okay. This is a reference to one of your slides when you were talking about expenses. And the question is, when you were talking about having high personal expenses, are you talking personnel, as in, you know, your own expenses, or personnel, as in employee expenses?
High personal, like your own personal expenses. I believe that was the point of that slide. Just it's okay to have those personal expenses and have them in there. If I'm answering that answer or that question, just knowing how to document them and move them, you know, and footnote them so that buyers can feel comfortable that those are not part of the operation going forward. High personnel expense, you know, the benchmark in that category, if I remember my slide, it was probably around 25 to 35%, I would say, and that just depends on, you know, multiple location, size of the firm, what have you. Okay.
You were talking about, you know, making sure that that you bring, that when you sell, you leave the you know, your staff in place. But we have a question here: what if you run a one-man show in regard to selling the funeral home? Does that impact the value? So if you're the only funeral director operating out of your particular business?
Yeah, it does. It won't be negative. It's, you know, so value is driven by, or what they call market value, and that is, you know, what is the market willing to pay for something, anything. It doesn't matter what it is. And so when you have a business where the owner is the operator, you're now looking for typically buyers that will want to do the same thing, or if you're involving in investor buyers, if you will, they're going to want to know who's going to be able to run that operation without them going to find somebody unless they have somebody. And so the cash flow is the same. The value that funeral home is producing is, in my opinion, is the same, but it presents a challenge, or can present a challenge, in ensuring that you know, who those buyers are by those that, again, can also own or operate. And that's where I use, like, the living quarters. That's a big attractive component of that. It's done. Those type of businesses are the majority of the businesses in the U.S., and they're great businesses in their small communities. It just takes, you know, takes a little more time, and so just be prepared for that time frame and schedule it accordingly on when it's time to consider a sell in that scenario.
Okay. When you were talking about tax returns, apparently it spooked some people. So the question is, how do you validate a tax return to make sure that it's...
Good point. So in my experience, the one where I learned a lesson, I did not have it signed. It was not signed by the tax preparer, and it was not signed by the owner. It was a copy, I was told, of the tax return that was submitted. And what I realized is the tax return had not been submitted in that format. And so, you know, getting an actual copy of the tax return that was submitted to the IRS, that's signed by the tax accountant and the owners, was the lesson I learned. But using tax returns in general to help validate the financials that you're receiving, that you're working off of, is always appropriate. And the reason I say that is typically the P&L, the internal financial statement and P&L, it's just going to have more detail for you as an operator to understand, you know, the different expenses that are going on there that make sense to you as a funeral operator. The tax preparer doesn't really care as much for that. He doesn't need to. So he lumps that all together. And so having a tax return and looking at what the end result net income was compared to the internally generated P&L is an important checkpoint.
Okay, and we have a ton of questions, so I think we'll do a few more, and then I'll make sure that you get the questions when we're done here, okay? So now, what are you seeing with private equity interest in funeral service, and what do you think we'll see in the future?
There's a lot of interest in it. The comments that I've heard from those people is that there's a lot of money out there right now, and few areas to put it is the way one person put it, and or that as it relates to looking at the prospects of the investment return, if you look at it as an investment for a moment, that a funeral home can provide with the real estate, it's very attractive, and so we've seen a lot of investor equity interest in the funeral space once again.
Okay, and we have a question here from somebody who I think took to heart your admonition to prepare early. He says he's looking at selling in 6 years. Should I get a valuation now to better prepare if changes need to be made for better valuation?
That's a great question. I hope everybody listens to this one. If that's the plan, get a valuation done now and get a strategic plan started. Those are things that we do for customers that have been invaluable to finding out, developing that roadmap of getting where they want to be. I mean, it's absolutely a start now.
Okay. And here's a question on the multiple. You had talked about a 6 times multiple, and the question is the 6 times multiple sort of the average, and what causes this to change?
Yep. So the value matrix is really what causes that to change. It's all of those outlying non-financial Q&A components that I outlined in this presentation that will be invaluable for yourself to determine the range of that. Would I say it's an average? I'd say it's probably close. I work on so many numbers that I can tell you that it's, if I had to add them all together, it's probably just a tick below 6 times. Let's call it like 5.9 or so. I mean, it sounds ridiculous, but I have so much data that I could tell you that it gets that exact. So it's close, yeah.
Okay, yeah, we had a couple of people asking, is six times sort of a realistic multiple to shoot for, and it sounds like it is.
It can be. Again, the problem the cautionary statement on that is reviewing that value matrix, understanding that, are you the average firm for that average multiple? And therein lies the question, because the average firm could be different sizes, but have different answers to those value matrix questions. And keeping in mind that the real estate can play a big part of this, and we have firms that we're looking at that we're helping right now where the real estate is a very high component of the value. And so while nothing would indicate that the multiple should be more, the value will end up being more, not from a facet of a multiples per se, but just the fact that if you want to own that business with the real estate, it's just going to cost you more.
Okay, and this is sort of, I guess, along the same lines. With eroding revenue due to loss of value, lower cost of cremation, fewer services, how does that figure into the purchase price?
Yeah, I mean, you need look no further than those impacts on value slides at the end of this presentation, and how that impacts the business to the bottom line. We're all going through it is the good news. If your top 3 isn't qualified help, lowering profit, and rising cremation, then I don't know what your top 3 is at a funeral home. And the question is, what are you doing about it to mitigate that? And your training, in your expense management, in your pre-need marketing, in your advertising. There's only so many things you can do, but there are things you can do. And then ultimately, at some point, as long as there's opportunity for somebody else, you still have great value in your business. But make sure it's there if you ever consider something like that.
Okay. We have a question. Once you have your EBITDA, how is the value of the firm determined? Is it a 1-year average, 2-year average, 4 or 5-year average?
Yep. So the EBITDA ends up being a result of averages. So what happens is, you're stacking your financial statements. What you would be doing in that financial preparedness slideshow that I showed is that you're taking 3 full years of P&Ls and you're trending them. You're determining averages or recent weighted averages, or In the case of payroll, you're actually going through each staff member, figuring out what their pay is going to be when you, as the buyer, move in there, and what the benefits look like. And so you're rebuilding based on a trend and averages the EBITDA. And so when you get to the EBITDA, that's exactly what you've created, a very hybrid, customized trend analysis of the last 3 years.
Okay. We'll do maybe one or two more questions. You let me know.
Sure. No, keep going. Yeah.
Okay. If you buy a firm that has cremation cannibalizing burial, how do you project how much debt service the firm will support?
Well, if you're buying a firm or you have a firm where cremation is cannibalizing burials, then you're one of everybody. So that's happening, and that's okay. I mean, that's where there's opportunity. The thing you have to look at, and I did my weekly management financial review today. I actually was reviewing last month's financials of my firm. You know, we look at what the EBITDA is, and we're looking at our debt payments and monitoring that closely, because I like numbers, probably number one, but it's an important thing to look at, and we know we have a high cremation where my business is. So how does it impact value? It's the way you find that out is you're budgeting at least on an annual basis, because the good news is typically it's not happening overnight. If it is, then you need to do a new budget, you know, and then look at what that is going to look like in your forecast in the future. So budgeting is going to be one way to really stay on top of that, especially if you're seeing some immediate trends that you need to forecast. Forecasting, definitely.
Okay. And I don't know if you can answer this one, and this might be something that they need to reach out to you personally, but it says, I'm interested in making a valuation on a cocktail level. Nothing official for a third party, just an internal gut check. Do you have a pro forma Excel that I can use?
Yeah, so we call this our napkin approach valuation style. So this is kind of similar to the old days of two guys sitting at a table and one puts a number on it and slides it over. The way we do that is reviewing that through our templates, not documenting footnotes, not going into deep asset analysis or payroll analysis, and coming up with a general idea of cash flow. The templates our templates are proprietary, of course, but you know, creating the model for that, what I would suggest to the person asked the question is, you know, take those slides that I have in this presentation and create sections on an Excel sheet that have each of those major categories: sales, cost of goods, payroll, facility, what have you. And using the buckets that I've provided and anything that would fall under those buckets, then you trend those, you take the items off the P&L that you've received, and you start making adjustments and see if those benchmarks fall in the ranges I provided. And if they do, then you're looking good. If they don't, you know, there might be some personal expenses in there, or some further review of the payroll analysis, and or just you know, trending more precisely what you think revenues will be, and you'll end up with a general EBITDA number that, you know, could be a good starting point. That in the case of the other question I had, as far as, you know, loans and how do we get that started, you then take that rough model to a lender that, you know, that's out there and that we assist with as well, and they'll start helping you narrow in on what other questions you might need to ask. So.
Oh, okay. I guess we'll do one more, and then we'll wrap things up. When you mention a 6x multiple of EBITDA as an example of valuation, does that typically include the purchase of both the business and the property, or only the business?
Typically it does. I've seen that in rare circumstances not, but that's very rare. So typically that includes the real estate, and if that causes pause because your real estate is exceeding that, well, then now we need to look at the business differently. Is this a business that it's going to be a business transfer only to a competitor? Is this a business where we need to determine the value with the building being leased? I would love that as an owner if I ever sell my business, but the fact is I've now, you know, you really eliminate quite a few buyers that, you know, that real estate is an attractive piece of acquiring that business. So, yep, it includes the real estate, the business, the name, phone number, goodwill, and that also includes, it's going to include a covenant not to compete within that value. And unlike other small businesses, we're talking about a covenant not to compete. Regardless of what the attorney would say in any state, it's probably going to be 10 years. And I say that because other small business, fields would struggle with ever the concept of a period that long, but it's very real, the goodwill associated with that seller, and it doesn't go away overnight, and it doesn't end in 2 years, that's for sure.
Okay. Well, thanks, Jake, and thanks, everyone, for taking the time to attend this webinar. We had several people asking